Hey, welcome back to the channel investors. If you have been following the Indian stock market over a decade, you've already witnessed that there are huge wealth creation which has happened in the past years. But while the index has given 12 to 15% return a year, there is specific breed of stocks which is exceeding this returns and which has just not just doubled, but it has given 5x, 10x, or maybe a 50x kind of return. So those kind of breed is what we want to discuss here, and that's configured as multi-bagger. In this video, I'm going to give you a complete masterclass that how to identify a multi-bagger and what are the examples of multi-bagger which are earlier there in stock market, which has given tremendous wealth creation opportunity to the investors. So let's just dive in directly into the slides. So first off, you can see that Peter Lynch has mentioned in his book One Up on Wall Street. He borrowed it from baseball, where bags represent the bases. In finance, a bagger simply refers to a stock returning to your initial investment. So, two bagger means your stock has doubled, or 10 bagger means that the stock has delivered 100 times in value, that is roughly 900% return on your capital. But here is a secret most people miss: multipacker aren't about getting lucky on a penny stock, they are the mathematical result of the magical compounding. If a fundamental strong company grow its profit by 20-25% every year, the stock will inevitably follow that earning trajectory over the 5 to 10 years period. In India's fastest growing economy, discovering these companies while they are still in the small and mid cap phase is as generational wealth will be built over time. So next up, we are going to look at that what is the DNA of a multi-bagger stock is. And so, first the numbers. The golden rule is growth is the engine. You want to look for the company that is consistently growing its sales in range of 10 to 15% and the net profit in the range of 15 to 20% year over year. Stagnant companies do not become multi-baggers. You need the growth to drive the valuations, but the growth mostly uh, consists cost money, which brings us to the second metric, that is ROC. So in terms of ROCE, the company which is doing ROCE greater than 20% is the company where you will be able to make the cash faster and you will be able to deploy the cash faster to help the future growths. Because the high ROCE means the business generating cash natively. It can fund its own expansion without having to borrow heavily. This is why you should always look for debt to equity ratio less than zero point 0.5 in the long term. So now we are moving to the quantitative sides of this. So you have to understand that the company which became multi-bagger in the past also has some criterias linked to it. So what has been called by great investor Warren Buffett is more that ultimately the moat relies on the pricing power or the irreplaceability of your product and the adaptability of your product into the customer's domain. So those kind of things creates a moat. So basically three things we have identified over here as a scalability in terms of the TAM. If your TAM is very small, then the growth anyways would be very stagnant because the industry itself is not growing. So if the TAM is expandable, and if you are having a very small market share currently in the larger TAM, so the chances of expansion become very good in that. A small fish in a giant ocean has an endless runway. Second, the pricing power during the inflationary cycle, can they raise price without losing the customer? So that's the thing. The trade-off generally industry takes is if you want the revenue growth, you have to sacrifice some of it in pricing. But if you raise the price, then you have to maybe shed some margin, shed some advertisement costs, or you have to shed the market share if you are raising the prices. So that's where the moat comes in. That if the product is so compelling enough, then you won't lose the market share even if the prices have been raised. Then your profit margins will be protected more or less, or will increase in the long term averages. And the management's integrity is also a very questionable thing in India. That the management is willing to distribute the wealth with the shareholders or not. Those kind of promoters we look into where the holding of the promoter, the skin in the game, is quite visible, and that the hunger and the drive from the promoter, how much it is. Then we have a case study where you look at Bajaj Finance, which has 40 bagger return in the past. So in 2014, if you look at Bajaj Finance, it has made humongous whales for the investors, because from a two-wheeler lender, it has pivoted itself aggressively, entered consumer durable financing, no cost EMIs, cards. So to buy TV, smartphones, Bajaj pioneered that at scale, backed by inevitable data analytics and approved loan in seconds. So those kind of tactics has really helped Bajaj Finance to gain market share and also expand its TAM. Then look at if you look at the numbers, the asset under management grew from 4,000 crore to 3.3 lakh crore. So that's a 30% CAGR over a decade. Then the net profit exploded from 720 crores odd to 1,414 crores in 2014. So, and that too keeping the NPS in check. So that is quite remarkable performance of the last finance. So 40 bagger return means that 1 lakh become 40 lakhs in a matter of 10 years. So that kind of compounding really helps you grow your wealth at a multifold speed. Then now how we will be able to find the next multi-baggers, what are the spaces we should be looking for. So I've listed down few spaces, but we have to also look beyond these spaces as well for the multi-bagger identification. Downs up and bottoms up is what we have to understand in businesses to identify the multi-bagger capabilities in those stocks. So EMS sector is one of the sector which is producing huge benefit to India. If you look at the Apple's supply chain, it will be backward integrated in India, and now India has become the second largest manufacturer of iPhones in world after China, and that hub for manufacturing will be created in India, be it semiconductor, TVs or chips. So those kind of things you have to look for where the inflection point is, and you have to stick around for the capex cycle and to see that when the growth drives in EMS sector. Defense, so in terms of aerospace, many companies like Dynamatics as well as Sanseras are gaining long-term relation with Airbus and Boeing, where the margins are quite high, and you have a long-term relation with the client, and the moat relies in that the regulatory approvals and all. So that is kind of a CDMO business for the aerospace engineering. So high tech engineering is where you should look for. The energy transition is another theme where the power demands in terms of data center and AI will drive the force to the uh, uh, transmission lines and whole distribution channel for the power. You have to look at which companies will be gaining benefit out of it. And the third sector, which I have not mentioned over here, is the pharma. So in terms of pharma, also the China plus one strategy is playing for India very well. And here you can look for companies which are into APIs and CDMO, which are again there is a regulatory approval, and also the long-standing relation with the client helps you get the deals or the molecules in these spaces. And there are a lot of good companies which are operating from India, which is working on these technologies and futures, where you can look for the multi-bagger stocks. Third is a tailwind, which is itself provides. So India's EPS growth, which is linked to the GDP growth numbers, that is real GDP plus your inflation. So nominal GDP growth itself is driving the EPS sources. So you should pick multi-baggers from the mid-cap and small-cap space, which on to become future part of Nifty 50 indexes. Then where you can look for the multi-bagger stocks. So ultimately, there are many tools available in the market today. But what I personally use, I can suggest you that Screener is a great website where you can filter stocks, and uh, you can ultimately play around with the ratios and analysis that what kind of stocks you want, and what kind of sectors you are looking for. So that's where I do major analysis, and where you get entire data for the company, be it balance sheet, profit and loss, cash flows, and also they've introduced some premium features linked to your phone call transcript, which is generated through AI, as well as they are giving the key metrics which the company is operating in which industry, depending on that. So that you can use trend lines, you can use for the bulk buying and FII and DII tracking, and also the star investor portfolios and all. You can use trend line for that. Theory finance is also a gold mine for the fundamental research. It breaks down exactly how the company makes its money, showing you revenue by product segments and highly accurate market share data. And lastly, nothing beats reading all the actual annual reports and transcript, the holy grail of investing, where you read the bottoms up investing through phone calls, investor presentation, and annual reports. Nothing beats that. So next up we have that quote from Peter Lynch that in stock market the most important organ is stomach, it's not brain, because your brain can give you the multi baggers, but you should have the stomach to hold it for the down period as well as the up period. So if you have bought a stock and it fell down 50%, you should have the conviction that it will rise above from there. And if a stock you have bought at 100 and went up 150, you should have conviction that it will go further up from here, and you don't lose the major compounding process there. So that kind of stomach is required according to Peter Lynch, and be ready to hunt the multi-baggers. So ultimately, this is what the theory is for the multi-baggers. But in conclusion, I would really want you to understand this, that while finding stock, you don't know whether it is a multi-bagger or not. You don't generally invest thinking that it's a process that you build over time, that I will invest in a specific kind of company where I have the comfort and where I have the conviction. But while you are in company, you have looked for the annual reports, then suppose 8 to 10 quarters you have seen in the different cycles. You have seen company, how company is doing it, the how management is taking the decision. So there you will build the conviction, and then you will think that this might become a multi-bagger with time. And that's where the patience plays a role, where you have to look for 10 to 12 quarters of performance of the company, and think that what management is doing and what kind of industry trends it's coming out, and whether it is helping company, or it is giving boost to the entire segment, and what kind of optionality company is playing with, and what kind of optionality in future company would be able to capture because of its capabilities. So those kind of things you have to keep in mind. And I think multi-bagger is a philosophy, but you generally don't uh, think investing in a stock that it will become multi-bagger. It's a process that wherever you invest in right companies, few of them will be multi-bagger, but you should check your conviction in every few days to increase the location or decrease the location, and basis that only you will be able to outperform the indexes. So that's it from my side. Until next time, keep researching and happy investing. Thanks.